AI bubble explodes? What breaks first? And how investors survive it? AI is real. The technology is powerful. The question isn't, is AI useful? The question is, has the market priced AI like a guaranteed jackpot? And if the answer is yes, what breaks first when reality doesn't match the price? Because that's what bubbles are in practice. Not fake technology, but prices that assume perfection. Over the last 3 years, AI has pulled huge amounts of capital into 3 layers at the same time: compute, chips, servers, networking. Housing the compute, data centers, land, power, cooling. Financing the build-out, debt, private credit, structured funding. So let's do this properly. What would AI bubble explodes actually mean? What are the triggers? What are the warning signs? And most importantly, how do you avoid being the person who buys right before the mood changes? First, what explodes in an AI bubble? Usually not the technology. When people say bubble explodes, they typically mean one or more of these happens. Spending slows, CapEx decelerates, financing cracks, debt becomes a problem, expectations reset, multiples compress even if the business is still fine, a weak link fails publicly, a default, a canceled mega project, a sudden wave of write-downs. So the real debate isn't AI works or doesn't work. It's, does the money invested into AI produce returns fast enough to justify the prices people are paying today? 2. Why AI spending becomes the pressure point. The AI boom is, at its core, an infrastructure build-out. And infrastructure booms all share the same tension. Early on, everyone believes demand will be infinite. Spending accelerates. The payoff takes time. Eventually, investors start asking, show me the return. In the early phase, people tolerate weak near-term returns because the future is huge. In the later phase, they demand proof. And that's when priorities change from build more to prove profitability. This is where bubbles start leaking, not from one dramatic headline, but from a slow shift in budget decisions. The 3 triggers that can make an AI bubble crack. Trigger 1, ROI disappointment. Spending stays high, returns don't follow. This is the simplest and most common bubble trigger. The numbers disappoint. Not AI stops working, but something more boring and more damaging to valuations. AI products don't monetize as fast as expected. Enterprise adoption takes longer. Competition pushes prices down. Costs stay high. Chips, power, talent. Margins don't expand the way the market priced in. At that point, the story changes from growth at any cost to prove the return. And when that happens, companies do the most rational thing. They slow CapEx. That matters because AI is a chain. When CapEx slows at the top, demand ripples down through the entire ecosystem. Trigger 2, the financing cracks. Debt and refinancing become the boss. This is where it gets dangerous because debt doesn't care about the story. A lot of the build-out depends on financing. Debt can be fine when cash flows are stable and visibility is high. Debt becomes lethal when utilization is uncertain, pricing is unclear, projects depend on continuous refinancing, the cost of capital rises. If credit tightens, the weakest projects are forced to sell assets, cut expansion, renegotiate contracts, or default. This is a classic bubble pattern. The technology can keep progressing, but the financing channel breaks first. Trigger 3, a supply wave hits. Oversupply crushes pricing power. Data centers take time to plan and build. That time lag creates the classic boom dynamic. Demand looks endless. Everyone builds. Supply arrives with a delay. Suddenly, the market realizes supply isn't scarce anymore. When oversupply hits, the first thing that breaks isn't AI usage. It's pricing power. And once pricing power breaks, the math becomes brutal. Lower lease rates, more incentives, lower utilization, weaker cash generation, and then refinancing gets harder. Oversupply is how optimism becomes a balance sheet event. But AI might not be a bubble. fair, demand for compute could keep compounding for years. Real-world use cases are still expanding. Infrastructure ecosystems are being built around AI. So yes, this might not explode tomorrow. AI could keep growing for a long time. But investors don't get hurt because AI is real. They get hurt when the price paid assumes a world that doesn't arrive on schedule. That's the difference between a great theme and a dangerous trade. What to watch if you want to spot the crack early? If you want a practical dashboard, here are the signals that often shift before the headlines. 1. CAPEX language changes. Listen for words like optimization, efficiency, prioritization, pacing, disciplined spending. That's often the first sign the cycle is turning. 2. Credit stress in AI-adjacent financing. Watch for refinancing getting more expensive, stricter lending terms, risk-off behavior in markets. Financing stress often arrives before earnings stress. 3. Data center utilization and pricing signals. Watch for pricing power fading, incentives increasing, vacancy rising, projects delayed or paused. This is how oversupply shows up in real life. 4. Supply chain push-outs. Slowdowns often appear as delivery schedules pushed back, inventory normalization, customers delaying purchases. That's the ecosystem telling you demand is cooling. How investors survive this without pretending to time the top. This is the part that separates investing from emotional gambling. Rule 1. Separate the business from the ticker. When prices drop 20-30%, ask, did the business change or did the mood change? Bubbles punish people who don't know what they own. Rule 2. Avoid leverage and fragile balance sheets. In booms, leverage looks smart. In slowdowns, leverage becomes the driver of outcomes. If you want resilience, prefer businesses that can fund themselves, don't depend on refinancing, can survive a bad year without panic. Rule 3. Don't buy perfection pricing. You don't need formulas to understand this. If a stock price only makes sense if everything goes perfectly, then you have no breathing room. The market doesn't reward almost perfect. It punishes it. Rule 4. Prefer cash reality over stories. When the story is loud, go find the quiet truth. Can the company turn revenue into cash? Does it have pricing power? Does it generate enough cash to justify the spending? This is how you stay calm when the market becomes nervous. Closing. So, AI bubble explodes? The honest answer is we don't know when moods turn. But we do know what usually breaks first. ROI expectations, financing structures, supply waves that crush pricing power. AI can still be one of the most important technologies of our lifetimes. And at the same time, AI-linked assets can still become overpriced. That's not a contradiction. That's markets. Next, we can make this even more practical. The AI stock checklist. A simple 10-minute routine to judge whether an AI-related stock is priced for reality or priced for perfection.